They bail out the banks. You pay the bill. They say history doesn't repeat. But when it comes to bank bailouts, it doesn't just rhyme. It plays the same song over and over. Every few decades, the system breaks. And instead of fixing it, the same hands rebuild it in their own favor. From 1907 to 1933 to 2008, and again in 2023, the pattern is identical. Banks gamble. Banks fall. Governments panic. Taxpayers pay. In this video, we'll uncover the hidden rhythm of financial rescue, the bank bailout cycle. 4 crises, 4 rescues. One rule, they save themselves, not you. We'll travel from J.P. Morgan's smoky back room in 1907 to Roosevelt's fireside assurances in 1933, to the flashing Wall Street tickers of 2008, and the digital age panic of 2023. Because behind every collapse lies the same question. When the system fails, who gets saved? And who gets sacrificed? Act 1. The historical setup. The story begins in 1907, a year when the word panic wasn't just a metaphor. It was literal. Crowds gathered outside banks, pounding on doors, begging for their money. In just a few days, over 240 banks failed across the United States. There was no Federal Reserve, no safety net, just chaos. The cause? Speculation, greed, and a failed attempt to corner the copper market by a few wealthy financiers. When the scheme collapsed, confidence evaporated overnight. But then, one man stepped in. Not a president, not a government. J.P. Morgan. In his New York mansion, under candlelight, he locked America's most powerful bankers inside a library and refused to let them leave until they agreed on a rescue plan. Morgan poured millions of his own money into the system. He forced rival banks to backstop one another. He even pressured President Roosevelt to delay antitrust lawsuits, just to keep the markets calm. And when the dust settled, J.P. Morgan emerged as the savior of American finance. But there was a hidden price. The government realized that the U.S. banking system was too fragile to survive without a central figure pulling the strings. So in 1913, just 6 years later, they created the Federal Reserve, a centralized bank that could lend to other banks in times of crisis. The idea was stability. The reality? A machine that could create money to save banks, at the cost of everyone else's purchasing power. It was the first cycle, a collapse caused by greed, followed by a rescue that only strengthened the players who caused it. And that pattern was just getting started. The story didn't end with J.P. Morgan. It only sets the template. Cycle 1. The Great Depression. 1929. Banks had lent recklessly throughout the 1920s, feeding a speculative frenzy on Wall Street. Margin loans, borrowed money, financed the illusion of prosperity. Then, in October 1929, the illusion shattered. The stock market fell nearly 90%, wiping out fortunes overnight. By 1933, over 9,000 banks had failed. Families lost everything. Yet when the government intervened, who did they save? The depositors? No, the banks. The Reconstruction Finance Corporation, RFC, created in 1932, injected billions into failing institutions. But small-town banks didn't see that money. It went to the same giants who had fueled the bubble. While Americans stood in breadlines, Wall Street quietly restructured and re-emerged stronger. Cycle 2. The Savings and Loan Crisis. 1980s. Deregulation allowed hundreds of S&Ls to make high-risk loans. When interest rates spiked and defaults followed, over 1,000 savings institutions collapsed. Taxpayers covered the damage, a bailout costing $132 billion, one of the largest in U.S. history at that time. Executives walked away rich. Ordinary people, they paid through higher taxes and inflation. Cycle 3. The Global Financial Crisis, 2008. Lehman Brothers collapsed. AIG followed. The world froze. The U.S. government unveiled TARP, the Troubled Asset Relief Program, funneling $700 billion to rescue the financial system. Banks that had gambled with toxic mortgage assets were rewarded with liquidity and low-interest loans. Within a year, many of the same banks paid out record bonuses. But homeowners? 8 million foreclosures, entire neighborhoods abandoned. The pattern repeated, exactly as before. Each bailout saved the system, but sacrificed the public. Each recovery was built on new debt, deeper control, and greater dependency on central banks. And now, the variables are the same once again: greed, leverage, and political fear of collapse. The question is no longer if it happens again, but when it's happening again. Only this time, the stakes aren't national. They're global. In March 2023, the collapse of Silicon Valley Bank sent shockwaves through the modern financial order. A $209 billion institution, gone in just 48 hours. The second largest bank failure in U.S. history, only rivaled by Washington Mutual in 2008. And the cause? The same old recipe, just updated for a digital age. Cheap credit, reckless risk, and a blind faith that the Federal Reserve would always step in to clean the mess. And it did. Within days, the government guaranteed every single deposit, even those well above the FDIC's legal insurance limit. The official line was, "We're not bailing them out. We're stabilizing the system." But semantics don't change math. It was a bailout, simply renamed. They called it a backstop, a softer word for the same old trick. Behind the scenes, the Federal Reserve quietly opened new emergency lending facilities, channeling hundreds of billions of dollars to stressed banks. The same story played out again. Profits privatized, losses socialized. Executives who ignored risk kept their bonuses. Shareholders who misjudged the market were spared. And the public? They paid, not with taxes this time, but with inflation, debt, and the silent theft of purchasing power. Because every dollar printed to save the system devalues the one in your wallet. Meanwhile, the structure of banking itself has transformed. In 1990, the 5 largest U.S. banks controlled just 10% of all deposits. Today, they hold over 45%. Power is consolidating faster than ever. Fewer banks mean fewer failures, but also fewer choices, and more control in fewer hands. And this time, there's a new variable rewriting the equation. Digitization. Enter central bank digital currencies, CBDCs, touted as innovation, marketed as stability. But beneath the surface lies something far more profound and dangerous. A currency that can be tracked, programmed, even restricted in real time, where every transaction leaves a trace, where the same institutions that once gambled with your savings now gain the power to monitor how you spend them. They say it's to prevent another crisis. They say it's to modernize finance. But history whispers another story. Every technological revolution in money, from paper to plastic, from plastic to digital, has shifted control upward. And this one could complete that process. Because once money becomes code, whoever writes the code controls the economy. The same pattern continues. Only this time, it's faster, more efficient, and more total. Greed creates instability. Crisis destroys confidence. Bailout restores the system. Power consolidates further. But the fifth step, digital reconstruction, is new. And it's already underway. This isn't just about banks anymore. It's about rebuilding the entire financial operating system from the ground up, one line of code at a time. The next bailout won't need meetings in marble halls. It'll be executed in milliseconds by algorithms and central bank dashboards. And when that happens, the question won't be who gets saved. It'll be who gets left out, because in this new cycle, money itself is no longer the lifeboat. It's the leash. The system that once printed your salvation could now program your obedience. Every empire, every system, every currency believes it's different, that its collapse will somehow be avoided, that the rules of history will be rewritten just this once. But history has never agreed. When Rome debased its silver denarius, it began as a small compromise. A little less silver, a little more promise. Then came the inflation. Soldiers demanded higher pay. Merchants lost faith. Trade collapsed. By the 3rd century, the once mighty empire was minting coins made of bronze, coated with the illusion of value. A mighty civilization reduced to counterfeit confidence. When revolutionary France tried to rebuild its broken economy in 1790, it printed the assignat, paper money backed by confiscated church lands. At first it seemed genius, but within 5 years the same cycle repeated. More printing, less trust, and finally, worthless paper blowing through the streets of Paris, soaked in the rain of its own failure. When Weimar Germany collapsed in 1923, it wasn't sudden. It was arithmetic. Prices doubling every few days, savings wiped out, families burning cash for warmth. Once again, the system protected itself. The people paid the price. Every crisis began the same way. Governments protecting the system, not the citizens. And every collapse ended the same way. A reset, a new currency, a new order. Now, The modern world stands on the same precipice, only higher, and with further to fall. The U.S. national debt has surged past $35 trillion. Global debt? Over $300 trillion? That's more than 3 times the world's GDP. And yet, we keep printing, borrowing, pretending. Every bailout of the last century was paid for with borrowed money. Every stimulus was a loan from the future. And every illusion of recovery compounds like interest on the truth. Because debt doesn't vanish, it migrates. From banks to governments, from governments to citizens, and eventually, from citizens to collapse. When trust in money fades, civilizations don't face recessions. They face resets. Not by choice, but by necessity. Today, economists whisper about soft landings. But history rarely lands softly. It crashes. Then rebuilds, under new rules and new rulers. The warning signs are flashing everywhere. Inflation remains stubborn. Wages can't keep up. Global inequality widens. And the same architects who designed the last bailout are quietly drafting the next one. Under a digital name, the formula that once saved nations may soon be the one that ends them. Because every empire reaches a moment when it's no longer too big to fail, but too broken to save. 4 crises, 4 rescues, 4 times the same story, told with new names, new faces, and slightly different excuses. Each time, the system trembled. Each time, the people panicked. And each time, it was saved. For them, not for you. The same banks that gambled with borrowed money walked away untouched. The same executives who signed off on reckless bets cashed their bonuses. And the same politicians stood before the cameras promising that, this time, reforms will stop it from happening again. But it always happens again. Because this isn't capitalism in its pure form. It's crisis capitalism. A system engineered to privatize profits and socialize losses. Where every mistake at the top becomes a bill at the bottom. Where risk isn't punished, it's recycled. And the cost isn't just money. It's trust. Trust in the system. Trust in the currency. Trust in the very idea that hard work equals stability. When that trust fades, societies change. People withdraw from banks, from markets, from hope. They stop believing the numbers. They start believing survival. And that's when systems begin to decay. Not from the outside, but from within. Because every bailout sends a silent message. You don't matter. The system does. The 1907 panic, the 1929 crash, the 2008 meltdown, the 2023 bank runs, they all carried the same invisible signature. The handwriting of history repeating itself in ink made of debt and denial. This isn't just about money anymore. It's about power. Who creates it? Who controls it? And who pays to protect it? The too big to fail banks are bigger than ever. The regulators meant to contain them now depend on them. The cycle has evolved. It's no longer just a bailout. It's a bake-in. A system designed so that collapse itself becomes profitable. So, what happens when the next domino falls? A 5th bailout? A 5th emergency? A 5th promise that this time it's different? You already know the answer. When banks fail, you pay. When they win, they profit. And as long as that equation stands unbroken, the pattern will keep spinning, round and round, until something finally snaps. But maybe that's the real test of every generation, to see the pattern clearly, and still have the courage to break it. History doesn't change itself. People do, because every great collapse also carries a seed of rebirth. Rome fell, and Europe emerged. Weimar burned, and a new order rose. Perhaps the next reset won't come from boardrooms or central banks, but from the people who finally understand the script and refuse to play their part. If this opened your eyes to how financial power rewrites history to protect itself, subscribe, because the cycle is still turning, and the next bailout may already be in motion.